The stock markets across the world opened in red earlier this week, with the Taiwanese bourse taking the deepest dip of -8% in just 1 hour of opening. But why are markets collapsing? What is driving the crash we are witnessing? What is this Japanese carry trade? We're going to talk about this in a moment. Stay tuned and watch till the end to get first-hand details on why we might be facing the greatest recession of all time. Subscribe and let's get into details. The Japanese stock market has not been doing well over the last week. The Japanese index fund Nikkei 225 fell over 6.5% on Monday. Tender stocks also fell over 11%. Japan's top index fund, TOPIX, was halted from trading for a period of time. This led to panic selling, and in South Korea, they had to introduce a circuit breaker and halt trading of their top index fund after it fell 6.4%. Across the globe, major stocks were not spared either. Nvidia shed 7.77%, Tesla shed 5.86%, and Apple lost 5.56% of its share price. But what is causing all this? The imminent full-blown war in the Middle East? Let's dive in and see what is happening. The carry trade. But what is this carry trade we keep hearing about? Don't worry, I am here for that. Since the 1990s, Japan has been like living in an economic island. Every other country in the world has been experiencing inflation, but not Japan. Wait, what? Yes, you guessed right. Japan has been experiencing deflation as the world experiences inflation. Deflation is the opposite of inflation. Yes, this is real in Japan. Instead of money losing purchasing power in Japan, it gains purchasing power. Maybe they are not having enough babies, or they are not innovative enough. Who knows? This situation has enabled Japan to lower interest rates to the extent of even negative interest rates. Yes, you heard right. Negative interest rates. Absurd, isn't it? This enabled investors to arbitrage on the interest rates by borrowing at zero interest rates from Japan and investing the money in other governments' treasury bonds like those of the USA, which pay an average of 6% per annum, or Kenya, which pays a whopping 18% per year. This situation is basically what financial technocrats refer to as carry trade, a situation whereby you are able to earn income from borrowed money by arbitraging the interest. Imagine that. You are simply being paid for taking a loan. Unbelievable. But what is the problem with this arbitraging? Here is the catch. The Japanese currency, the yen, is generally stable over time or goes down because they experience deflation. Then now all of a sudden, Japan decides, let's raise interest rates because inflation is catching up with us. Then boom, the Japanese treasury bonds become desirable and attractive to investors. Now the Japanese yen appreciates and the investors who had borrowed money from Japan are losing money, and they are forced to liquidate their assets in the USA or Kenya to pay off their debts in Japan. This causes more pressure on the currencies as more traders are scrambling to acquire the yen at the same time, pushing it higher. This leads to panic selling as investors believe that they are in a sinking ship and the exit door is the selling option. I hope this was eye-opening on what happened in the markets today. Subscribe and hit the notification bell for more enlightening details on the markets as they unfold.